Well, we know the two certainties of life are death and taxes, two known events in our lives, cliched to true, but we tend not to be very well prepared for those. I'm not going to be talking about death today, but I'm going to be talking about taxes, more particularly personal taxes, self-assessment, and for those of you who are within the approximately 25% who are filing your returns in January or getting your accountants to file your tax returns in January, what I'm focusing on in today's broadcast, live broadcast, first one for me for this year, is the actual when it comes to paying the money. So for some of you, when it works out how much you owe the tax man, it'll be a little bit of a cardiac arrest, bit of a shock. And it's about thinking, what do I do to actually make sure I keep my friends at HMRC happy and content? And that's the focus on what we're going to be looking at today. For those of you who are listening live, thank you very much for your company on this very miserable weather-wise Saturday afternoon. I'm here in my office. I've just taken a small break from actually completing tax returns, coping with some Brexit stuff and COVID. So I thought, let me just pop in and do a little broadcast today. My name's Mahmood. I'm an accountant by practice. I've been in business about coming up to 26 years now. I'm an educator and a mentor, but today the focus is on personal tax. So by the wizardry of technology, I'm going to have a little bit of a mini slideshow just to reinforce some points that we're going to be talking about today. If you've got comments, by all means, please do share them in the comments box. If you've got questions, then pop them into the feed. I'll answer the questions as we go through. If you're catching up on replay, if you put in the hashtag replay, I'll know you're out there. If you're making comments, I can pick them up afterwards and address what's coming up. So let's crack on with the broadcast. And what are we going to be talking about today? So fundamentally, the focal point is about the actual paying of money over to HMRC, and we're looking at what's called the tax year 1920. So if you are one of the 12 million people who are filing a tax return or have filed a tax return, whether you're self-employed, whether you're a higher rate employee, whether you've got income that hasn't been taxed when you earn it, like rental income, then you will be within the tax return filing season. Obviously, if you had that sort of income created before, effectively, the 5th of April 2020. So I'm assuming you are eligible, assuming you're in that system. And what we're talking about is whether you DIY it yourself or you get your agents, your accountants to actually prepare the tax return on your behalf. We're focusing on the monetary side of things today. So what we're going to cover in today's session. So we're actually going to look at the tax bill. Now, if it's relatively new to you and you are filing your own tax returns, of which many millions of people do file their own tax returns, or your agent is filing your tax return for you, I want to just show you what your tax bill is actually made up of. Many people in their minds, understandably, when they work out what's going on for the 1920 tax year, crunch the numbers, it works out how much tax is owing, they might get a little bit of a shock because there's a perception in their own minds what tax is made up of. And I'm going to explain to you what those numbers are that will make up your tax bill in 1920. We're also going to look at something called a POA. This is what I'm going to abbreviate that from what's called a payment on account. So you could have been filing your tax return for many years. You could be a newbie to it. And when you look at the final calculation, you may have an idea in your own mind about what you expect to pay over. And suddenly you'll see an additional payment come up, and it's called a payment on account. And I'm going to explain what that is, what it isn't, and we're going to be looking at all things POA related. And lastly, what we're going to look at is payment options. So once you've worked out what the tax is, and when I say you can still do it manually. 99% of people now do it electronically. So you're either going to use HMRC's own tax return software. Your agent may be using their own dedicated software. But when it comes to the actual money that you've got to pay over, and the deadline is 31st of January 2021, by the way, so we're about 15 days away for when that deadline approaches. If you don't have the funds I'm going to outline 3 or 4 options that you can tap into to help ease that burden, ease that pain of paying it over. Okay, so we've got 4 options to look at. One of them is relatively new, by the way, wasn't really around for last year's tax return. So we've got 4 options that we can address. Let's, for those of you who come up, long time no speak, Jess Marina. So hi to you, hope you're well. I'm reading your post there as well. So hi to you, hope your mornings and afternoon is going well. Let's crack on. Now, before we go into some of the more nitty gritty as such, remember we're focusing on UK taxpayers or those taxpayers who've got UK income. You've got to file a tax return, and effectively we're not really looking at in terms of how you can reduce your tax bill. If you want to log on to proactiveresolutions.com or hmrc.gov, there'll be literature in there that tells you in more detail about what you can claim on your tax return. We've gone past that stage. It's the actual numbers that we're looking at. Fantastic. We're joined by some wonderful people here. Fellow live broadcaster herself. Bonjour Nadine, ça va? Hopefully Nadine doesn't go into too detailed a French conversation, because I will show my embarrassment by not being able to keep up. So bonjour Nadine, I hope you are well. Okay, let's progress on. So I want to look at the actual tax bill. So what we've done, we've gone through that process. We've looked at all the different income. We've punched it to the machine, and the machine spews out a figure, and it will show you overall at the bottom a figure that represents the tax that you owe. So there are effectively, what are the components that make up that number? Now, first of all, what we're looking at is we're looking at the 1920 tax year. So it's saying what was your income and any sort of capital gains that you've had between the 6th of April 2019 and the 5th of April 2020. Once the calculations take into account what you are allowed to earn tax-free. So for instance, you may be entitled to a personal allowance, subject to how much your income is. You may get other sort of tax reliefs like gift aid and the like, but effectively it will all filter through, take into account your status as a tax bill, and it will first of all show you what you actually owe for the 1920 tax year, what is due. Now, the tax calculations will take into account tax that you've already paid up front. So if you happen to be somebody who's salaried, you've got a part-time or a full-time job, you're likely to have paid tax during the course of the year through PAYE. That will be taken into account. You may be a taxpayer who receives income with a tax provider, well, the provider of that income has taken tax off you. The whole system of self-assessment, which is what we're in, takes into account untaxed income. That's what we're largely looking at, and things like capital gains, rental income, self-employed profits, dividends fall within that remit. So what's left over after we've worked out the tax due on your income, capital gains, take into account tax that you've already paid through, say, things like PAYE, and that will give you what's called amount due. The official language might be balancing payments. So let's say typically I look at my income for the year made up of salaries, rental income, some dividends perhaps from a company that I own partly or fully. I add those all together. I take off my allowances, any reliefs that I'm entitled to, and it says, Mahmood, you owe, for argument's sake, £10,000. Now, we've already taken into account that you paid through PAYE, the figure of £6,000, so that's £4,000 that you asked. That's what's called your balancing payment. So that's the first figure. Whatever's left outstanding, the amount due itself. Now, you may have also, by the way, made some upfront payments, which is what I'm going to focus on the next slide. So, for example, when we come on to the next aspect, here, you may have something called payments on account. Now, payments on account, I'm going to deal with more detail on the next slide, but let me just flag up now what this PAYE payment on account refers to. Now, once we've worked out how much is due to pay for the 1920 tax year, so that's tax on the income and capital gains, less any tax that you've already paid through things like PAYE, less any payments on account that you made from the previous year. Bear with me for a moment. That will be the amount that's left over, the amount that you pay. Now, if you are in something called a payment on account regime, I'll mention it now and I'll go into more detail on the next slide. Typically, a payment on account is where you've got to pay upfront, pay in advance of your next tax bill. Now, for those taxpayers already in the system from previous years, as part of the COVID's financial support options, the government and HMRC allowed you to defer your July 20 tax payment. Now, that would have been automatically done, by the way, unless you elected not to. So if you are already in the tax system, you would have made an installment of tax last January 2020. You would have made another one around about July 20. You had the option, and it was automatically done, by the way, to defer that July 20 payment on account. Obviously, what that means is, though, is that now becomes payable in your January 21 payment. So now we've got, what do you owe HMRC on the tax, on the income and the capital gains, less any payments already made. You then add in potentially your delayed July 20 tax payment. And there's one more thing you've got to consider now. And that's what's called the next POA. And it's the two aspects here, the POAs, by the way, that I'm really going to focus on after this next slide. So when you look at your tax bill that's appearing for 1920, three elements that make it up. How much do you owe for that 1920 tax year? Add in if you've had your July 20 tax payment delayed or deferred, and then take into account any payments on account that you might have towards next year's tax bill. Now, ideally, in an ideal universe, you know, if you're a rational human being who's not been sort of flummoxed and you do things in a particular way, you may be being very smug to yourself and thinking, do you know what? Well, it's not smugness, actually. It's good practice. I put the money aside. There's no surprises. I've got the money there. Fantastic. If it's not, then you've obviously got some challenges coming up. So that's the tax bill. Now, we're going to talk about this POA, actually, because that gives us some flexibility to perhaps mitigate and reduce what we might pay over to HMRC. So this is what I'm going to focus on, the payment on accounts. Now, just a bit of history, by the way, just to give you some background. The tax system we operate in the United Kingdom, which is effectively has got some similarities around the world, was introduced in the United Kingdom 6th of April 96 tax year. Ironically, that was about 2 years after I first created my own accounting practice. So when I started in business back in February 95, 2 years later approximately, well, a year and a bit, they introduced the system of what was called self-assessment. Now, part of that system, when it was introduced, it said it was a new change to say to taxpayers, complete your tax return, you tell us what's going on, work out the tax that's due, pay us that money. But also, what we want is we want to take some money off you as well at the same time going towards the following year's tax bill. And that's what's called a payment on account. So think of it as an advance payment that you make, which goes towards the following year's tax bill. So any payments on account that appear for your 1920 calculation goes towards your 2021 tax bill. And that's you paying up front for it. Now, in this, what I'm going to cover is, first of all, what is it? So visually, in your mind, think of it as an upfront payment towards your tax bill. And I'll give you some numbers in a moment just to illustrate the point. That's what it actually represents. So if we go back to my earlier example, I got let's say a tax bill of 10,000. Of that £10,000, then effectively that's the tax that's due for the year. Now, I will then have to pay a payment on account potentially for next year, because this is the rules that follow. Now, what HMRC are focusing on are those taxpayers who have income and capital gains which have not been taxed at source. So if you're in PAYE, you've got a job, your employer will be operating PAYE, the tax will be collected as you progress, and in theory, HMRC don't have any major issue with the vast majority of taxpayers who are within PAYE, because everything is collected on a regular basis through the tax PAYE system. What they're really interested in are those people who may have income that has not been taxed fully. And typically, of the 12 million people who will be in the tax system, self-employed, higher earners, PAYE, etc., then that will be tax that's not been fully collected and income that's not been properly assessed from an HMRC perspective. Now, here's the payment on account calculation. Once we work out the tax that is due, if it's over £1,000 and at least 80% of the tax has not been collected via PAYE, then it triggers a payment on account calculation. So if I think my tax bill is £2,000, let's assume I don't pay any PAYE. Let's assume all my income is from just self-employment. Then if it's £2,000, then automatically I have to make a payment on account. It's the default position, but we can modify that. And what it says is, of the £2,000 that you owe for that year, Mahmood, we want half of that, again, straight away. And when I say straight away, I mean by 31st of January 21. And then also, by the way, fast forward to July 21, we want another instalment of another £2,000. So what I'm faced with is a tax bill, let's say for argument's sake, of £4,000. Half of that will be added to my bill for my first payment on account. So that's about £6,000 that's going to have to leave my bank account in theory. And in July 21, I pay my next instalment of £2,000. And what does that mean? That means if I fast forward to 2021 tax year, as long as I've made my payments on account, I would have paid already £4,000 towards next year's tax bill. Okay, and that's the principle of how it's calculated. Now, remember, the calculation is what's called a default calculation. That's the position you assume. But the good thing for us is there are options to reduce what's called the payment on account. Now, let's have a think about what's going on. And I think it's quite pertinent, especially with COVID and what's happened, is there's the potential, and I'm going to emphasize the potential, by the way, to potentially reduce your payment on account. Now, just to keep things fresh, I'm going to use a completely different set of numbers. So I've got a situation where my tax bill for the year is £2,000. And remember, that's the tax bill for 1920. I take that figure because it's over £1,000 and because I haven't had my tax collected via PAYE or from other mechanisms at source, I've got to make a payment on account. Now, I'm looking ahead to 2021 because that's what the payment on account is going towards. Now, COVID could have been such that it's affected dramatically, adversely, my self-employed business, and my profits would have taken a nosedive. I'm saying potentially, you need to make that decision. Now, if your perception is, your calculations, that actually 2021 is a lower year in terms of profitability compared to 1920, then you would think to yourself, actually, my income next year is going to be much lower. Therefore, I'm not going to be effectively paying as much tax as I would have done in 1920. Then you've got good grounds for reducing your payments on account. Now, here's a little bit of a caveat. If you are self-employed, for example, and COVID has affected your business adversely, remember to take into account you may have received a self-employed grant. There are two that have already been made historically. We're in third grant number 3, which finishes on the 29th of January 21. And there's another one that's due in the fourth grant, effectively after that year. Remember, that grant is taxable, and that grant will be included as part of your 2021 tax return. So when you make your calculations, remember to take that into account. Don't ignore it. So effectively what you have to do is to think, how much tax am I likely to pay in 2021? Now, the reason you do it or your agent does it is because you make the claim to HMRC to say, okay, I was effectively going to have to pay £1,000 as my 2 instalments, but actually my profits have suffered, and I reckon my tax bill is going to drop to, let's say for argument's sake, no more than £1,000. So you can elect to reduce your payments on account to the magnitude of £500 for each instalment. HMRC are quite cool with that. You make the claim on either your online tax return, and you do it that way. If you filed your tax return already, by the way, it's not too late. You can go onto your government gateway account, or you can ask your agents to do that on your behalf. You can make a claim to reduce payments on account after you filed your tax return. Normally, when we do our clients, we normally do it at the point of submission. So we would have worked it out beforehand. We would have said, here's your tax bill, here's your payments on account, which is going to add to the amount you've got to pay. What's the situation looking like for 2021? If we think it's going to be a lower income position, for example, then we can make a claim to reduce the payments on account at that point. You may think, well, I haven't got a clue what's going on in 2021. Let 2021 go by. You can wait until March, 5th of April 2021, and then go back retrospectively. But remember, the emphasis, the onus is on you as the taxpayer to make that claim. And here's what happens. If it turns out to be correct, i.e., the reductions you've made in your payments on account equal or more than the tax you've got to pay, so you're actually correct in your assumptions and your calculations, excellent, no problem. If, however, it transpires that actually the tax bill hasn't reduced as much as you expected, and you've effectively reduced your payments on account by too much, two things will happen. First of all, HMRC will charge you interest on the reduction, on the underpayments as such. That's a statutory calculation, by the way. You can't mitigate that. They do, I've not seen that often happening, by the way. They do reserve the right to also levy a penalty if they think, these are my words, these aren't the official tax terminology, if they think you've been a bit naughty and a bit reckless with your making your claims. When you make a claim to reduce payments, you have to tell them or indicate, very generally speaking, the reasons you're making the reduction. So they do reserve the right to go back. And again, in 26 years of doing this, and obviously 24 years since SA has been in place, I think I've probably come across it twice in that period of time. But obviously, it would be reckless of me to say it doesn't exist. So when you do make those payments reductions, when you make those claims, look at it carefully. Look at what your income position is likely to be in 2021. What else is going on with any other transactions? Work out what you think your tax will be and make the reduction. Now, if you're a DIY taxpayer, of which there are many millions, you're doing it yourself, and you think, I have no idea what's going on, you've got two options. You either ask your accountant, and obviously if you haven't got one, that's going to be possible. So you get yourself an accountant, get an ad hoc piece of advice, get the calculations done. Alternatively, you make the first payment on account, you wait until the end of the tax year, and in April, May, June, as early as possible, you work out your tax return and submit it in accordingly. And therefore, if there is any interest element involved, it's only going to be for a small period of time. You'll have done it in time before the next July 21 tax payment. What I'm going on from here is payment on account will kick in once you go over £1,000. It's an automatic calculation. You can claim to reduce it. If there are no real grounds, because you think actually things are stable, they're not really dropped a lot, then obviously you've got that to consider and factor in. And having done it for all these years, I get lots of clients who, as their business prospers, as things get better, the payment on account suddenly becomes a bit of a shock once they trip over that £1,000 that's owed. Remember, the £1,000, by the way, is for income tax and class 4 national insurance. National insurance is also one of those taxes, maybe a topic for another day, that many taxpayers don't take into account when they look at their tax numbers. Now, I want to look at the situation now, just to conclude this, about what happens if you don't have the funds. What do we do? Now, here's the options you've got, by the way, for paying your tax bill. Firstly, full settlement. Now, as we generally advise our own clients is, if you are in a situation where you're self-employed, you run your own business, it's likely you'll have transitioned from maybe being an employee where your employer takes care of everything for tax-wise. You're now in a situation where the tax that you owe hasn't been collected off you on a regular monthly, weekly basis. So what that means is, ideally, you put money aside to cover your future tax bill, and you've got the funds, and you can make full settlement. As a rule of thumb, if you're relatively new or you've not done this before and you're thinking about for next year, every time you raise an invoice to a client, I recommend that you put a proportion of that income away in a separate account to cover your future tax bill. So ideally, you've saved the tax as you've gone along, you've got the funds to put to one side, you've got that financial discipline that's come in, you've worked out your cash flows and all the rest of it, the money's there, you can pay it, end of story, great. So that's full settlement, that's option one. What's the other way? Option two, if you find that you don't have the required funds to make that payment, and remember, 31st of January 2021 is the strict deadline for filing your tax return, that's task one, and the 31st of January 2021 is also the deadline, strictly speaking, for making any payments due for the 1920 tax year. And that will be any tax that you owe, any POA that's been deferred from last July 20, plus the 2021 first payment on account. Now, if you find you just don't have the resources, business hasn't picked up, you're not in a financial situation, you've had to use cash from elsewhere, and you just don't have the funds, you have the option of entering into a payment plan with HMRC. Now, there are two variations on the payment plan. The online one, which we talked about in a broadcast last year, is one where you can go online and do that yourself. Unfortunately, that option has lapsed now because you need to do it effectively by the end of November 2020. So you can't actually do it as a DIY online. However, you can contact HMRC. They call it Business Support Service, brackets debt management, take your pick, and you can discuss with them about a payment plan approach. I'm going to share with you, by the way, my thoughts about what you need to do to get together before you have that phone dialogue with an HMRC officer. I'm using that term very loosely, HMRC officer, because HMRC also employ a number of debt collection agencies who operate on their behalf. So before you talk to that person at the end of the phone, there are things that you should do in preparation. But payment plans are an option, and that's where effectively you arrange installments with HMRC to spread the burden of tax that you owe. You have to remember at this stage, by the way, that when you do talk to communicating with HMRC, you think of it like any dialogue that you have with a supplier where you don't have the funds to settle their account. So where you've got invoices owed and cash flow is tight because your customers haven't paid you, you don't have the funds, then you've got to enter into the same spirit of that. Now, HMRC do have a reputation unfairly. In my experience of most debt management officers, most business support officers, they're working very challenging times here. And if you'll approach it courteously, it may feel quite frustrating. Do not vent or vex at them. They've got guidance notes that they're following. They've got an approach they've got to follow. And they do take into account, obviously, that COVID has impacts on people's cash flows. So for me, they work very hard. They do a very thankless task. So if you're feeling frustrated for everything that's going on in your life in terms of business and tax, and you think, right, these are horrible people there, put that out of your mind. Treat it courteously. You also like to get a more receptive reaction. And they are very accommodating in my experience. What you must do, though, by the way, you must have filed your personal tax return. There's no point having a conversation with somebody at the other end on the phone if your tax return has not been submitted. They cannot discuss theoreticals, so get that tax return in. I would typically, by the way, give it about a day or two before you can make a conversation with HMRC, because that's the time it will take normally for the records to be updated. It may be quicker, but generally speaking, a couple of days, get it filed. So that's the first thing you've got to do, get it filed. Now, also, when you come to speak to them, make sure you've got things like your tax reference. They will, like any company will do, they will ask questions of you, probably a little bit more detail. They'll ask you, do you have the funds? How come you haven't got the funds to pay for it? And again, it may sound intrusive and it may be slightly disconcerting but it's the questions they will need to ask of you. They will ask you what facilities you've got, what have you done to try and arrange to pay your tax bill, and all they want to know is basically why is it you can't pay the tax bill? What's your income and expenditure looking like? What have you done to try and pay it already? Now, if they do accept it, and in my experience, every single client that we've dealt with and every single non-client we've dealt with, where we've directed them on to HMRC to make a payment arrangement, I can't think of anyone who's not come back and said we couldn't get anything sorted. If you've got an adverse tax record, by the way, and you've had payment plans with them before, you've had issues with them in terms of paying on time, your tax affairs are not brought up to date, then it's unlikely you'll get a payment plan proposal accepted. So you've got to have all your affairs up to date, make sure your tax return is filed. If they do agree that, then they will accept, obviously, installments. It will have to be paid via a bank. So typically a direct debit will be set up to actually collect the monies that they've agreed to. Obviously, if you default on that, then that all bets are off and effectively they can reserve the right to pursue it actively. Now, bear in mind also, by the way, one of the other advantages of talking to HMRC, don't effectively not talk to them, is you'll avoid any penalty surcharges for late payments. Interest will be charged, by the way, and they will work out the interest that's going to be effectively rolled up and put into those payment installments. So interest off the top of my head is 2.6%, and that will be added to an instalment arrangement that you have set up with them. Now, this is relatively new, by the way. There is also something separate called a budget plan. Now, this is not the same as the payment plan. The payment plan is something where you say, HMRC, you as a taxpayer, can I pay this tax bill over the next X number of months? Okay, that dialogue will be had between the two of you, and they will set up a payment plan. A budget plan is something completely different. Now, if you feel actually, and we in our client family, we've got clients who've got a whole range of approaches and attitudes to HMRC and paying tax. Some people get very nervy and they just want to get the payments out of the way so they know they've made them. Other people are a little bit more relaxed about them. But a budget plan is where you can arrange via your own personal tax accounts to actually pay the tax yourself, just like a savings account, but instead this money, instead of sitting in your own savings account, goes directly into HMRC's coffers. So you could say, well, actually, what I'm going to do, I go into my personal account. You can delay payments up to 6 months as well, by the way. I reckon I owe this much money, and I'm going to make an arrangement. I put an amount in each week or each month, and it's a budget plan. So it's not an installment arrangement, but it's where you put that money aside, and that money you put aside goes into the coffers of HMRC. And when it comes time to filing your tax return, you've hopefully paid all of it. Anything you've underpaid will be dealt with when you submit your return and for the 31st of January 21. There is a fourth option. Do nothing. Put your head under the duvet, ignore it completely. Obviously, I would not recommend that. One, not just for the surcharges and penalties, but you do not want HMRC coming after you assertively. Remember, they do use external debt collection agencies. So yeah, it is an option. My personal view in all these things is get the return in, figure out what you owe, talk to HMRC and make that arrangement. Now, 2.6% interest on any outstanding tax debts, factor all of that in terms of what your cash flow situation is looking like. Folks, listen, I hope you found that useful. I'm just going to sort of turn the screen off for a second or two, take out the screen. So I hope you found that useful. I'll add some links at the end, by the way, for HMRC contact numbers. So don't delay. As I said, there are about 25% of taxpayers who file returns in January. I'll hold my hands up by that. I know how much tax I've got to pay for the year 1920. I haven't actually filed my tax return yet, by the way, because historically, I always file mine probably in the last week or so, because mine goes on the back burner until all clients are done. But effectively, I know how much I've got to pay, so I've got my own fortunate situation sorted out. If you haven't, don't delay, don't hide under the tree, don't hide under the duvet, get your return in, figure out your tax bill, because it's not going to go away. If you want to get some more information, log on to the website, proactiveresolutions.com. There's some information, not just on tax, but on Brexit, on business planning, all things numbers related. I also do a weekly podcast. Next one comes out tomorrow, and it's actually picking up from a theme from last week on business resilience. Until then, hope you like the episode. Any comments, chuck them into the box. And for that, I would suggest everyone have a fantastic rest of the weekend, and I'll see you very soon. Let us play out with a beautiful song.